Something extraordinary is happening in the gold market right now, and if you're not paying attention, you could miss the most significant wealth-building opportunity we've seen in over a decade. I'm not talking about some minor price fluctuation or temporary rally. What's unfolding right now is a fundamental shift in the global monetary system, and the next few weeks will determine whether you're positioned to profit or left watching from the sidelines. Let me show you exactly what I'm seeing, because the evidence is overwhelming, and frankly, it's keeping me up at night. Right now, as I'm recording this, gold is trading near all-time highs. But here's what most investors don't understand. The price you see on your screen, that number flashing across financial networks, it's not telling you the real story. Behind the scenes, there's a massive divergence happening between paper gold and physical gold, and this gap is widening by the day. I was looking at the COMEX data last week, and something caught my eye that I haven't seen in my entire career. The registered gold inventory, that's the physical gold actually available for delivery, has dropped to just 412,000 ounces. Now, you might think that sounds like a lot, but let me put this in perspective. There are currently open interest contracts representing over 50 million ounces of gold. That's a ratio of more than 120 paper claims for every single ounce of physical gold available for delivery. Think about that for a moment. If even 1% of those contract holders decided they wanted physical delivery instead of cash settlement, the entire system would collapse overnight. And here's the thing. They're starting to ask for delivery. In the last 3 months, we've seen delivery requests spike by 340% compared to the same period last year. But it gets even more interesting when you look at who's taking delivery. It's not retail investors. It's not even hedge funds. The largest delivery requests are coming from sovereign wealth funds and central banks, institutions that have access to information you and I will never see. They know something, and they're acting on it with urgency. Let me tell you about what happened in Singapore 2 weeks ago. The Singapore Bullion Market Association reported that physical gold premiums, the amount buyers are willing to pay above the spot price, hit $45 per ounce. In normal markets, that premium is typically $2 to $5. A $45 premium means buyers are so desperate for physical gold that they're willing to pay nearly 2% above spot price just to secure metal. That's not normal market behavior. That's panic buying disguised as institutional accumulation. And Singapore isn't alone. In Shanghai, the premium hit $52 per ounce. In Dubai, it's $38. In Mumbai, $41. All across Asia, the world's largest gold-consuming region, buyers are paying massive premiums for physical metal, while the paper price in New York barely budges. This tells you everything you need to know about where the real demand is, and more importantly, where the real value lies. Now, I want you to understand why this is happening right now, at this exact moment in history, because the timing isn't coincidental. There are 3 massive forces converging simultaneously, and together, they're creating what I believe will be the most explosive gold rally we've seen since 1980. The first force is central bank buying, and the scale of what's happening is absolutely unprecedented. According to the World Gold Council, central banks purchased 1,037 tons of gold in 2023. That's the second highest annual total on record. But here's what should terrify anyone holding dollars. The buying accelerated in the first half of 2024. We're on pace for central banks to purchase over 1,200 tons this year. But it's not just the quantity, it's who's buying and why. The People's Bank of China has been adding to its gold reserves for 18 consecutive months. They're not reporting the full extent of their purchases. We know this because the import data from Switzerland and the UK doesn't match their official reserve increases. Conservative estimates suggest China has added at least 400 tons more than they've officially reported. Why would they hide their purchases? Because they don't want to drive the price up before they've accumulated enough. Russia, despite being under the most severe sanctions in modern history, has increased its gold reserves to over 2,300 tons. They've essentially replaced their dollar reserves with gold. And they're not alone. Turkey, India, Poland, Singapore, they're all accumulating at record pace. Poland increased its reserves by 130 tons in just the last 18 months. For a country that size, that's an enormous commitment. But here's what really tells you where this is headed. These central banks aren't buying gold as an investment. They're buying it as a replacement for the dollar. Every ounce they purchase is an ounce they're not holding in U.S. Treasury bonds. This is de-dollarization in real time, and it's accelerating. The second force is the debt crisis that nobody wants to talk about. The U.S. national debt just crossed $35 trillion. Let me say that again because the number is so large it's almost meaningless. $35 trillion. The interest payments alone are now over $1 trillion per year. That's more than we spend on defense. More than we spend on Medicare. We're paying more in interest than we're spending on the entire discretionary budget. And here's the mathematical reality that should keep every investor awake at night. There's no way to pay this back. None. Even if we cut spending to zero, which is politically impossible, we couldn't pay down the principal. The only way out is inflation. They have to inflate away the debt, which means they have to destroy the purchasing power of the dollar. The Federal Reserve knows this. Treasury Secretary Yellen knows this. Every economist worth their degree knows this. And that's why gold is moving. Because sophisticated investors understand that the dollar's purchasing power is being systematically destroyed by design, not by accident. Now, let me show you something that most analysts are completely missing. If you look at gold's price in dollar terms, yes, it's near all-time highs. But if you look at gold's price in terms of the money supply, in terms of M2, gold is actually still 40% below its 1980 peak. Think about what that means. Despite all the money printing, despite all the debt, despite all the geopolitical chaos, gold hasn't even caught up to where it was 44 years ago when adjusted for the expansion of the money supply. This tells you two things. First, gold is not in a bubble, not even close. Second, when gold does catch up to its historical relationship with the money supply, we're looking at prices north of $4,500 per ounce. And that's just to reach parity with 1980. If we see the kind of monetary expansion that's likely coming, we could easily see $6,000 or higher. The third force, and this is the one that's going to catch most investors completely off guard, is the supply crisis that's building in the physical market. Gold mine production peaked in 2018. Since then, despite higher prices, despite massive exploration budgets, production has been flat to declining. The easy gold has been found. The high-grade deposits have been mined. What's left requires more energy, more capital, and more time to extract. But demand is exploding. Global gold demand hit 4,899 tons in 2023, the highest level since 2011. And that demand is shifting. It used to be that jewelry demand from India and China drove the market. Now it's investment demand and central bank buying. This is much stickier demand. These buyers aren't going to sell when the price goes up. They're accumulating for strategic reasons. I was talking to a dealer in London last month, someone who's been in this business for 30 years, and he told me something that shocked me. He said for the first time in his career, he's having trouble sourcing large quantities of physical gold. Not because of price, but because it's simply not available. Refineries are running at full capacity. Mints are backed up for months. The physical market is tight in a way he's never seen before. And this is where it gets really interesting for anyone thinking about their retirement security. You know, if you're sitting on $100,000 or more in traditional retirement accounts, there's something you should know about. I put together a free guide on how gold IRAs actually work. It's in the description below. It covers exactly how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. It's worth checking out if you're concerned about dollar devaluation and want to protect your retirement savings with real assets. I'll get back to where this market is headed in just a moment. So where does all this lead? Let me walk you through what I think happens next, because the setup is almost identical to what we saw in the late 1970s. And if you understand that period, you understand what's coming. In 1971, Nixon closed the gold window. The dollar was no longer convertible to gold. For a few years, nothing happened. Gold traded sideways. Investors didn't understand the implications. Then, in 1976, something shifted. Smart money started accumulating. Central banks started diversifying. And by 1980, gold had gone from $35 an ounce to $850. That's a 2,400% increase in less than a decade. But here's what most people forget about that rally. It didn't happen in a straight line. There were massive pullbacks. In 1975, gold dropped 25% in just 3 months. Everyone said the rally was over. Then it doubled. In 1977, it dropped 30%. Everyone said it was finished. Then it tripled. The investors who made generational wealth weren't the ones who tried to time every move. They were the ones who understood the fundamental drivers and stayed positioned. We're in a similar setup right now, except the imbalances are far larger. The debt is far higher. The geopolitical tensions are far more severe, and the loss of confidence in the dollar is far more widespread. When this moves, it's going to move fast, and most investors won't be positioned. Let me show you some specific levels I'm watching, because this is where the technical picture confirms the fundamental story. Gold recently broke through $2,650, which was major resistance going back to the 2020 highs. That breakout was on massive volume, which tells you institutional money is involved. The next major resistance level is $2,800. If we break through that level and hold it, we're likely going to see a very rapid move to $3,200. But here's what I'm really watching: the gold to silver ratio. Right now, it's sitting at about 84-1. Historically, when gold enters a major bull market, silver outperforms dramatically, and that ratio compresses to 50 or 60-1. We haven't seen that yet. Silver is still lagging. But when silver starts to catch up, and it will, that's when you know the real mania phase is beginning. I'm also watching the mining stocks, because they're telling us something important. The GDX, the major gold miners ETF, is still 45% below its 2011 highs, even though gold is at all-time highs. This is a massive divergence. Either gold is going to collapse, which I don't believe given the fundamental drivers, or mining stocks are about to play catch-up in a spectacular way. The leverage in quality mining stocks right now is extraordinary. Now, let me address the elephant in the room, because I know what some of you are thinking. What about Bitcoin? Isn't Bitcoin the new gold? Doesn't crypto make gold obsolete? Look, I'm not anti-crypto. I think Bitcoin has a place in a diversified portfolio. But here's the reality. When central banks want to diversify away from the dollar, they're not buying Bitcoin. They're buying gold. When sovereign wealth funds want to preserve wealth across generations, they're not buying Ethereum. They're buying gold. Gold has been money for 5,000 years. It survived every empire, every currency, every financial crisis. It has no counterparty risk. It can't be hacked. It can't be printed. It can't be confiscated remotely. And most importantly, it's recognized and accepted everywhere in the world. Bitcoin might get there someday, but gold is there now. And here's something else to consider. In a real crisis, in a scenario where the financial system is under severe stress, what do you think will be more liquid? A digital asset that requires electricity and internet access, or a physical asset that's been used as money since the beginning of civilization? I'm not saying Bitcoin won't do well. I'm saying gold is the ultimate insurance policy. And right now, insurance is severely underpriced. Let me tell you about what happened in 2008, because there are some important lessons there. When Lehman Brothers collapsed, gold initially dropped. Everyone needed dollars to meet margin calls. Gold fell from $1,000 to $700 in just a few weeks. Everyone said the gold bull market was over. Then, as the Fed started printing money, as governments started bailing out banks, gold went from $700 to $1,900 in less than 3 years. The investors who panicked and sold at $700 missed one of the greatest rallies in history. We could see something similar in the coming months. If we get a liquidity crisis, if we see a major market correction, gold might pull back temporarily. But that pullback will be the buying opportunity of the decade, because the response to any crisis is going to be more money printing, more debt, more currency debasement. And that's the environment where gold thrives. I'm also watching the geopolitical situation very carefully, because this is adding fuel to the fire. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based system. They're settling trade in local currencies. They're building payment systems that bypass SWIFT, and they're backing these initiatives with gold. At the last BRICS summit, there was serious discussion about creating a gold-backed trade currency. Now, I don't know if that's going to happen, but the fact that they're even discussing it tells you everything about where we are in the dollar's life cycle. When major economies are openly planning for a post-dollar world, that's not a conspiracy theory. That's a fundamental shift in the global monetary order. And it's not just BRICS. Saudi Arabia, for the first time in 50 years, is accepting payment for oil in currencies other than dollars. The petrodollar system, which has been the foundation of dollar dominance since 1974, is breaking down. Every oil transaction that doesn't go through dollars is one less source of dollar demand. And when demand for dollars falls while supply continues to increase, there's only one possible outcome. The dollar's value has to decline. Now, here's where this gets personal for most investors. If you're holding your wealth in dollar-denominated assets, stocks, bonds, cash, you're making a bet that the dollar will maintain its purchasing power. Given everything I've just shown you, is that really a bet you want to make? Is that a risk you can afford to take with your retirement savings? I'm not saying sell everything and buy gold. That's not prudent. But I am saying that if you don't have meaningful exposure to physical gold right now, you're taking on more risk than you probably realize. The traditional 60-40 portfolio, 60% stocks, 40% bonds. That worked great in a world of stable currencies and declining interest rates. But we're not in that world anymore. In the world we're entering, a world of currency debasement, geopolitical fragmentation, and loss of confidence in institutions, you need real assets. You need things that can't be printed, that can't be debased, that have intrinsic value. Gold is the ultimate real asset, and right now, it's the most under-owned asset class relative to the risks we're facing. Let me give you some specific numbers to think about. The total value of all the gold ever mined is about $15 trillion. The total value of global stock markets is about $110 trillion. The total value of global real estate is about $330 trillion. The total value of global debt is about $310 trillion. Gold represents less than 2% of global financial assets. If investors decided to increase their gold allocation from 2% to just 5%, we're talking about $2 trillion of new demand flowing into a market that produces about $200 billion of new supply per year. The math is simple. Prices would have to rise dramatically to balance that equation. And here's the thing. That reallocation is already starting. We're seeing it in central bank buying. We're seeing it in the physical premiums in Asia. We're seeing it in the tightness in the wholesale market. The smart money is already positioned. The question is, are you? I want to close with this thought, because I think it's the most important thing I can tell you. We're living through a monetary regime change. These don't happen often. The last one was in 1971, when Nixon ended gold convertibility. Before that, it was 1944 with Bretton Woods. Before that, it was 1933, when FDR confiscated gold and devalued the dollar. These regime changes create enormous wealth transfers. Wealth moves from those who don't see it coming to those who do. From those who stay in the old system to those who position for the new one. Right now, we're in the early stages of this transition. Most investors don't see it yet. They're still operating under the assumption that the dollar will remain the world's reserve currency forever, that central banks will always be able to control inflation, that the debt doesn't matter. But the evidence is overwhelming that these assumptions are wrong. And when the market finally wakes up to this reality, the move in gold is going to be explosive. The most important period of the year isn't about some seasonal pattern or technical setup. It's about the fact that we're at an inflection point. The decisions you make in the next few weeks about how to position your portfolio could determine your financial security for the next decade. This is not the time to be complacent. This is not the time to assume everything will work out. This is the time to look at the evidence, understand what's happening, and take action. Gold is telling you something right now. The question is, are you listening?